Hey, I'm here with a new guy today. We're doing this video on seller finance notes and what he does. He's got a little bit different twist on how he looks at different things. Introduce yourself. What's your business name?
Scott Schmitz. Work at Northstar Investment Group. We're down in Southwest Florida, the Sarasota area. Florida, the affectionate name of the home of sunny places and shady people.
For heaven's sakes.
But hey, we got OJ.
There you are.
Got to keep it real.
And yeah, get out there on the golf course. And
because of our homestead laws. They're the best in the country outside of Texas. That's the reason why we get a lot of people, shady people hiding money for homestead, but it makes sense.
So what you're doing some stuff with private investing. Tell me a little bit about that. You're buying private investor notes that are non-performing. I buy institutional notes that are non-performing. So tell me about your end.
Great. So what we do with Northstar Investment Group is we buy what is quoted in the industry saying is owner finance mortgages. So what that means is mom and pa cattle have a house. They're done with the house. They're going to move downsize, right size, upsize, whatever. But there's an issue with the house. So they got to sell that to somebody. Maybe there's a handyman, electrician type guy. And he's like, I can buy it and fix it up, but I have bad credit. Maybe I don't have the down payment. So will you carry back the mortgage? And they do. This loan is created. So it's originated by the owner. Seller finance, usually there's one of two things wrong with it. Either there's a problem with the borrower or there was a problem with the property. Otherwise, it would have been a traditional financed mortgage.
Yeah.
Okay, so it's the fallout. It's the breadcrumbs. I believe there's between 100 and 120,000 loans a year in residential created across the country. The three largest states are Texas is number one, and then Florida and California are number 2 or 3 respectively for creating loans. Texas creates about 30,000 owner finance loans a year just for residential, commercial as well. Florida and California about 10,000 each. So the niche that we specialize in is we buy the majority of them are performing because the philosophy that I came into with is, in my opinion, liquidity in the world is king. And the reason why is because you cannot spend your cash flow, or I'm sorry. You cannot spend your equity. Okay? Yeah. And cash is for one reason and one reason only, to be spent. Think about it. We hoard gold. We spend cash, but they both have value. So the same theory applies to notes or home ownership. We hoard equity because we have to, and we spend our cash flow. Well, I guess I live in the world, I want to do stuff, and if I can't spend it, I can't do stuff, so that's why we buy a lot of performing loans. The reason why is owner finance is because banks, I don't have $500 million to go buy a giant pool of performing loans bank paper, okay? So by default, I have to go to owner finance. Now within that, we do see a lot of defaulted loans as well. So because I was in the area of I want cash flow, I never really got into the institutional paper of the defaulted space.
Yeah.
And obviously it's you can make a lot of money on it. Just you guys have figured this out. But because of that, we do see some defaulted paper, and we buy mostly defaulted owner finance loans, which when it's a defaulted owner finance loan, I found that because I'm buying it directly from the person who originated it, I can really negotiate on the price. Now with that being said, it's not beautiful collateral all the time. Sometimes it is.
Yeah.
But it's a trade-off. Okay? If I can buy it for 20 cents on the dollar and it's a $50,000 asset, okay, I can justify that. But if you had to pay 50 cents on the dollar for that same $50,000 asset because it was a bank originated loan, could you justify that? I don't know. Can you? I'm actually asking.
A bank originated loan for 50%?
But it's a $50,000 asset.
Yeah, sometimes. So it just really all depends on what grade and what area and stuff, of course.
Sure. So a $50,000 loan, odds are it's B, C, somewhere.
Yeah.
Probably not the greatest.
Probably, yeah.
But everything, my opinion is everything has a price.
Okay.
So if you have garbage, okay, I'll pay you nothing for it then. And I'll figure out a way to turn those. I mean, Warren Buffett said, you know, you walk around and you look for these cigar butts and you pick them up and pretty soon you've got a whole cigar worth of cigar butts. And he goes, once you can do that, now you can do something with it. You can either smoke them or sell them. So I guess that's the theory of how I came about. Yeah.
Okay.
I mean, it's, you know, the theory of you start small and you work your way up.
So how many of these Harry loans, private loans are you buying a year? Are you seeing them? Are you buying them? What are you doing with them? Are you personally buying them, or are you buying them with your company?
So with the defaulted loans, those are ones I buy personally, and the reason why is our capital is specifically pledged to buy performing loans.
I see. Yeah, sure.
So I guess maybe one of the reasons why I'm much more aggressive with it is I will not lose. I will not find myself in an asset that doesn't make money.
And you're gonna go into that looking at the whole situation of, I'm gonna buy this. This is my exit, and you've got some kind of an idea that the property has some type of value.
Oh God, yeah, we underwrite it the exact same. You know, the performing world and the non-performing world, at least from what I know and how we do it, it's underwritten the exact same. We look for taxes, we look at BPO, value, we want clear chain of title. Now, a lot of times with defaulted loans, you don't get clear title.
And so you've got to clean the title up somehow.
Yeah, so in that becomes part of the pricing. Okay, you got 4 years of back taxes, it's going for tax sale right now. You know, it's all gets underwritten the same. So you just put that into the pricing, and then it's part of your cure process. So if that were a performing loan that we were buying, that would get fixed before we would ever even buy it. Because we need clear
all the title. Okay,
correct.
gotcha.
You know, that has to get fixed because we buy performing loans with title policies. I want chain of title. Why? Well, if I want to resell it to somebody, they want clear chain of title to know that their asset is clear.
Sure.
Part of the process. So, I mean, and once you throw it over to the defaulted, it doesn't matter who originated it, you have to underwrite it the same. So you underwrite a performing loan the exact same way as you would underwrite a defaulted loan. It has to check all the boxes. The only difference is once we buy that performing loan and throw it into a portfolio, we're done for all intents and purposes.
Now, you sell these you bundle them up and sell them to institutions?
No, we keep about half of what we get.
Okay.
Just because of cost of capital, you know, for our investors, we have to pay X amount. We're buying them at a discount, so we keep the difference, obviously, to pay for lights and things. But because of that, there are some larger institutions out there who they can undercut you in prices. So basically, the A paper stuff that's like a 700 credit and above, maybe there's like 30-40% equity with a couple of years of seasoning on it. That stuff goes to institutions, whether it's some banks or hedge funds or insurance companies. We just sell it to them, and then we take a fee. It's part of the liquidity. But the other stuff, like the B paper, where maybe there's something that we have to fix in title, I can use that and we can buy it for cheaper. Hey, you got a loan, there's 3 years of back taxes, you're holding the property, the note, why don't you go fix it? You, Mr. Seller, you're like, ugh, I don't want to deal with the headache. I'm like, you know what, I'll deal with your headache, but you're going to pay for it. And you have people, notes are weird, they're like houses. And I don't know what this is, but literally, when people are done with the house, they will move and they don't care what they sell it for. When people are motivated to move, they will sell their house at a loss just to get out of Dodge. Notes are the same way that I've found dealing with.
When you found a hairy note, when you found a
Even
bad
clean
note,
notes.
even clean ones. They've held it for a while, and the
They're done.
whole thing is wore off. The mystery is wore off.
What are you going to do with $400 a month? If you are not an investor and you're getting paid $400 a month, and literally, you didn't do this as a business. You
Yeah.
did this because you were forced to, because you had to move to, you know,
And you didn't have any other.
that was your
alternative.
only one.
Yeah,
You're
that
holding
was
one
your out.
note.
Yep.
What are you gonna do with $400 a month? I'm holding an $80,000 loan, amortized over 20 years. It's $600 a month. That's $7,200 a year. I'm not servicing it correctly. I'm not in compliance. I don't even know that I'm not in compliance.
Yeah, I don't even know what compliance is.
Yeah, because we're Joe, mom, and pa, and I'll walk in and I'll give you 60 to 70% of that, the balance.
Yeah, and they can see, feel, and touch that.
You can do something with 40 grand.
Yeah, and then a lot of investors, $400 a month on a note, like, hey, can I buy 10 of these? You know, that'll make sense.
And that's the economies
But
of
that's
scale.
not, yeah.
So now when you buy enough of them, you throw them in, and your overall cash flow is 20 grand a month. Okay, and for an investor, because we're set up for this, to bring back to the investors,
Yeah.
where are you gonna go? Okay, so yeah,
So you find all these NPNs, private non-payers, and do you find those all over the United States, or what kind of mistakes do these people make on their paperwork that some of it's like, you know, the property's okay, but the paperwork's so bad? Do you find a lot of that stuff?
Yeah, so stuff comes to us on the basis of, hey, we buy performing loans. We buy performing owner finance loans. But people call us because they know that we've either been referred to or on our marketing pieces we say, but we also buy your defaulted loans. So what we've found is these defaulted loans, a lot of the times, for whatever reason, the default happens. And since the person who's holding the loan isn't a business person, they don't know how to get it back on track. They don't understand that, hey, if you'll cut the rate, cut the payment, you can get these people back on track. You know why? They're emotionally attached to that cash flow because they originated it. Think about it. You love your children.
Sure.
You really don't give two
Yeah.
hoots and Hades about everybody else's child relative to your child.
Right.
I, as a third party, can look at this and see the clear, obvious as day. The other thing that is so interesting to me is a lot of these times the borrowers and the homeowners have had it, the borrower and the note holder have had it out. Things have been said. Now we've created this animosity.
Yeah.
I hate you, you hate me.
It's an intense situation, sure.
And I can come in and exploit that.
Okay.
No. Joe note holder, you ain't ever fixing this because they hate you and they'll take you to court. I call up the borrower and say, you hate Joe note holder, you don't pay them, they're going to sue you and take you to court. Because that's the reality. Look, that's where all roads end at the courthouse.
That's where it's gonna go, yeah.
I go, how about we do this? I'm a new face, new person. I'm going to give you a fresh start. I don't care about your past. I don't care how you got here. I'm going to fix the problem. Joe note seller, I'm going to fix your problem. You are not going to have to deal with that person anymore. And I will buy it at a discount. Yeah, you're going to take your lumps, but you can write it off on your taxes. But hey, I'm getting rid of your pain. I'm going to take that sliver out. And you know what they do? They gladly sell. Now, out of every 100 of these we find that come our way, we'll buy 10 of them.
Ah,
So it's economies of scale. I think every year over the past 4 years, I've bought between 3 and 5 defaulted loans a year. But the numbers are on 100 that come our way, 10 of them we buy. That may be spread over a couple of years.
Okay.
But remember, our primary business isn't the defaulted space.
okay.
So we're buying, for every loan that we buy that's defaulted, we're buying 20 performing loans.
Oh, nice.
Because I want the cash flow. Now look, I'll give it to the defaulted space. You can capture equity. You buy a defaulted loan, you fix it, you buy it at 50 cents on the dollar. Now the property gets improved or whatever. Now you have this equity that you can now sell and capture. But I can do the exact same thing with a performing loan. I buy a performing loan at a discount of between 60 and 70 cents % of the balance. $100,000 loan, I'll buy it for 50 or 60 because you want your money now. And then I'll turn around and I'll sell it to an investor who's getting 0.000% at the bank, they're happy to get 7-8%. And when you factor that in, that $60,000 loan that I bought for, I just resold for 75 or 80. Because they're getting their yield.
Yeah.
Well, I've created equity instantly on a performing asset that I didn't have to go through all these hoops to get people back on track. They're already on track. And that's the reason why I can do that with our money. The defaulted stuff, I have to do it with my own personal money. Whether we venture into that or not, I don't know.
Yeah, and that's where a lot of the investors are today. They're doing it with their own money on the really bad stuff, and it's outside of their business plan and their business model. That's what they're doing, and that's what I mean. That's what I do.
Sure.
That is apparently what you do. So, it's a theme within. Everybody's got to figure out what their niche and what their theme is, and that's kind of what people are doing now.
Sure.
So, yeah, if it's outside of your company's business plan, and you're seeing this and you're going, it's a pretty good deal if, and you can fix all the ifs, then it moves on. What else you got? Just give me a few minutes more, and
Sure.
What's really humming in the private lending, private mortgage business right now? Is it going up? We had a lot of changes. Is it going up? Is it going down? Is it staying flat? This is the norm. It's been this many people doing these private loans all this time, or is it increasing in the private loan market?
So the origination is actually going down. It's gone down every year since of 2008.
Okay.
Because of home prices have come up in about 30% of the country. The majority of the country home prices are not even at 2008 levels. I mean, outside of Case-Shiller, I don't care what the media tells you, outside of the large Case-Shiller, I think top 40 index, those markets are not back to 2008 as a market in general. Pockets of it, yes, maybe. So the country in general, from what I've seen, isn't there. And the reason why I know this is because a lot of our notes with owner financing get generated in those markets that weren't bank financeable. That's why I know this. Because,
sure.
Okay, that's one of the problems. The property was the problem.
Yeah.
Because it was in this market. With that being said, we buy single-family houses, we buy mobile homes with land. I love mobile homes with land, and here's the reason why. They'll borrow. Homes don't pay you. Borrowers pay you. Human beings pay you.
Oh.
So why a credit report is important is it gauges how well that person keeps promises. Because remember, promissory notes, that we're buying. We're buying promises.
You're buying a promise, sure.
Okay, so what I've learned, and many people attest to this, renters are the bottom feeders. They have no promise longer than a contract of 12 months. And their deposit.
Yep.
Most they can lose. So renters are the absolute worst, in my opinion. Homeowners are the best, with a modest payment, $1,000, $200, $2,000 a month, tops. Once we get above that, anything happens, it's a strain to pay that. Okay, strain to pay a $10,000 a month mortgage. Even if you're a neurosurgeon, it rolls up quick. If you don't have proper insurance and things like that, you're 60 grand in a year, and it's only been 6 months.
Yeah.
What's interesting though is, so mobile homes with land, those people they want to own, hence they're buying the mobile, which means they have pride of ownership. Even though it's a mobile, they are proving they are good people. Now if they have okay credit and whatnot, they've proven they probably have a job, so they're above a renter, but they're below the single family residential homeowner. Well, here's the thing, it's a perceived risk. So because it's a perceived risk, it gets discounted more. So if I normally...
I do mobile homes, so yeah, I know what you're saying.
So if it's normally, let's say a single family house with decent paper, and I gotta buy it at a 15% yield, okay, I discount it to equal me a 15% yield. Okay, Mobile home, I can automatically go to 20. Why? It's a mobile home.
Yeah.
Well, but they're good pairs. Yeah, but it's a mobile home.
Yep.
Yeah, but they got a good down payment and a good job. Yeah, but it's
Mobile home.
still a car title.
Yep.
And it's
And a deed.
in a deed, even if it's affixed to the land, it's a 1978 Volkswagen. It's a 1978 Buick. How much value does a 1978 Volkswagen Scirocco have right now? Maybe to a collector a lot, but not much. Well, if it's a 1978 mobile home, even though it's been remodeled to the nines and they're grid pairs, it has nothing as value. Yeah, if it's a brand new mobile home, 120 grand on it, brand new, triple wide, okay, that has value. So therefore, I get to buy that cash flow because we invest in people, not property. The property is only our CYA in case the people stop being trustworthy.
Yeah.
That covers the collateral, so in theory, I have to buy most mobile homes at land value. Even
Right, and
though,
that's why I look at it too.
yeah, even though that cash flow may be $500 a month. So let's think about that. If that were a single family house valued at $80,000, I now have to then factor that in. Let's say the note is for 70, the property is at 80, I'm 100% covered by my collateral. I have to pay more for that exact same $500 cash flow as opposed to an $80,000 loan with a value of the property of 50, and we got to write down the mobile to be worth 5,000.
Yeah.
That's why I can discount that more. We have higher yields, but the default rate's the same.
And the default rate is the same as what you're.
Pride of ownership.
Yeah.
If you own something, it doesn't matter where you are. It's like literally a quantum leap. Renters are here. Even pride of ownership on crappy things are way up here. How do we see it? You have really old cars that people take good care of. They have pride of ownership because it's theirs. Once again, we get back to the psychology of you care about your child more than your neighbor's child, relative to yours.
We're going to wrap this up, and it's been wonderful talking to you. I
Likewise.
really appreciate your information.
Yeah.
So I think it's good information. Hopefully this will be interesting to the people that get on my channel and look.
Yeah.
And so.
Check his channel. Remember to like and subscribe and smash that thumbs up.
Thank you.
You're welcome.